Guy, come on, if you're hoping for a quiet day in the markets, crude has not been your friend. Brent, as we've seen, has plummeted below $60 a barrel with higher trading volume than normal. For more now on how this has been playing out, we have Mike McGlone, commodity strategist for Bloomberg Intelligence. You're joining us here for ETF Friday. Walk me through the significance of getting below on WTI below $50 a barrel. There's psychological importance, yes, and there's an emotional importance as well.
Well, 50 is key support, but I have to admit, I thought 60 was key support and should hold. But the significance of actually breaking below 60 now near 50 is it should take the Fed tightening out of the picture only when that is coincident with lower stock market. And that's what we're getting. Typically, when you have a velocity of this type of move, stocks declining and crude oil declining, the Fed's typically easing. Now, that's not happened yet, but we're still prices are tightening in a month. But in terms of ETFs, what's happening is there are inflows, because that's a unique thing about ETFs and energy. Typically, they flow opposite prices because they're highly leveraged in energy. We've seen flows into crude oil ETFs. A lot of these triple leveraged long ETFs, crude oil, have done very well, and some of the best performers have been the triple leveraged long. The triple leveraged short crude oil did well, but the triple leveraged long natural gas did very well. So the significance of ETFs is a lot of tactical trading in energy and more buy and hold trading in precious metals, which is the majority of the market.
Are they not used for buy and hold because of the roll factor, Mike?
Yeah, exactly. Guy, you got it. It's the roll factor. And right now that's actually in backwardation, which is somewhat positive in crude oil and natural gas. But it's the history of lower returns. By holding, you lose the roll. But in precious metals, typically the ETFs hold the physical, so you don't have the roll issues.
What are you seeing in gold and some of the other commodities that you were looking at as well?
The key word I used to describe gold ETF holdings is unstoppable. They're just so strong. So basically, in the last 3 or 4 years, gold ETF holdings, notably since the Fed tightened, are almost 10 times the appreciation of gold. Just up maybe 50% or so, and gold's trickling up 4 or 5%. And that significance is, it looks to me like ETF holders and using gold ETFs are looking forward to the end game from the Fed, potentially from the stock market volatility picking up. And I don't see what's going to take to end that. And what I'm worried about is you look at gold and a trade-weighted broad dollar at a multi-year high. Gold is, the risk is, I'm fearful, it has a lot of upside. And I think ETF holders are reflecting in that.
Mike, can I ask you a question that kind of Taylor brought up when we were talking with our last guest, and that is about gold and Bitcoin. Bitcoin was seen as sort of superseding gold as this non-correlated asset that didn't have a relationship to fiat currencies, and as a result of which acted as some sort of a hedge. Bitcoin is plummeting right now. Does that favor gold? Is that in any way behind what we're seeing in the gold movement and the gold flow right now?
Yeah, we did a deck early in the year pointing out the benefits of gold versus the excess supply in Bitcoin. Bitcoin is sometimes called digital gold, but I think it's being proven that it's less digital gold than people really thought. It's just too speculative, excessive. But you look at looking at a strategist, gold has a much better outlook. And the thing about Bitcoin, it needs to come down to be as volatile as gold. To me, that's my point in Bitcoin. It kind of needs to get to where cryptocurrencies need to get to where gold is in terms of not moving around much and the store value and less speculative. But right now, to me, as a strategist, I view gold as a more favorable investment.